Hello, my favorite traders. Today is Wednesday, August 10th, and we had the CPI data come out today. CPI bulls and bears, oh my. I am still sick with a cold. It is not the Rona. It is a summer cold, as my aunt likes to say. I don't know what the difference is between a summer, a fall, or a winter cold, but that's apparently what I have. So I hope you're doing well. We had the consumer price index data come out at about 8:30 a.m. Central. 8:30 a.m. Eastern. For me, I'm on Central. That's 7:30 a.m. And the thing about this data coming out, one thing that you need to know if you've been trading for a little while is you always want to look at the economic calendar for the week, see what releases are coming up, see what's going on, because that's going to affect if you're trading the S&P or NASDAQ or the Dow. That's going to affect how the futures markets, how they all move. So when the data comes out, there tends to be the first move, which is the reaction that the market's already priced in, and then there's the actual real or continued move the next day. So we see when the data came out hot at 7:30, we jumped up from 41.38 all the way up to 4,200, which is a huge psychological level. It really matters to the bulls to keep above 4,200. Now, CPI data came out and it was, I believe, 8.5% was the data. So that is good. But you want to be cautious when these announcements are made, because they're often tends to be like this huge spike up that you can see here, and it's really a move that sets you up for a trap. So if you got caught up in it, I'm back. I had to pause the recording for a second because a major bolt of thunder and lightning scared the crap out of me while I was recording, and you don't need to hear that. So anyway, we were talking about the CPI data. CPI data came out and it made this huge crazy bull run up. Just from my experience, I've been trading for about a year. I am an aspiring trader. I'm by no means an expert or a professional trader by any means. But one thing I have seen is that when these economic releases come out, there's the initial move, which is like a huge, massive bull run, and then there's the continued move the next day. And also what happens is after these moves occur, we tend to have a basing period where we will just kind of sit in this little range right here. We'll sit in a range pretty much after the moves happened. So you can see here, we went all the way up to 42.12, and then we're just kind of hanging out right around here now. It's another thunderstorm. So we're just kind of hanging out in this area. I today have chosen to put myself on the sim, or simulated trading, aka paper trading, because I had a loss yesterday, and I will explain that to you in a quick second, what happened yesterday. And if I have 2 losing days in a row, I just stick myself on the sim. So number 1, my inner cave woman doesn't come out. Number 2, I don't revenge trade, and I don't have FOMO. So it's kind of like a little behavior modification that I do for myself, because I know myself I'll want to make back everything in one day, which will cause me to go on tilt, which will wreck my account. And honestly, sometimes sitting on your hands and preserving your capital for when there's better opportunities is the best way to be in the game for the long haul. Being in cash is a position, and choosing not to trade is also a trade. Like a really good trading psychologist, Randy Howe, he says that you want to be an ambush predator, right? I know sometimes we think that when we're trading, we're working at it, we're going to make a trade happen, but often that's not really the case. We don't get paid for our time as traders, we get paid for taking advantage of opportunities as they present themselves. So yesterday, what happened was, I'm just going to switch back here into regular trading hours so you can kind of see now, because of the CPI data, we have this crazy gap up. And yesterday, before the data came out, and this was my mistake. So normally I look at the economic calendar for the week to see what kind of data is coming out, what's going on, because I know that's going to affect how the market moves. And I did not look at my economic calendar because normally I put each week like what's going on my regular Google Calendar so I can see it. I didn't realize that the CPI data was coming out until later in the day. So that was my bad because I kept looking at, man, we are just trading in this dumb range of 41.38 down to 41.14, which was about a 20-point range. And yesterday I took a trade. I was actually up $900 in the trade. I was up about 4 points, and I thought we were going to have a little bit more continuation. We chopped around this area, so I thought I placed my stop at break even, but I didn't realize I didn't place it at my break even point. I left it at my original entry point where it was. So when this happened, I thought, okay, well, this is kind of holding. I thought we were going to go up, and then we went down really fast, which caused my $600 loss. And after that, I was like done for the day. So it's my mistake. And I also forgot to hit record. So there you go. So anyway, getting back to the economic data, it's really important to watch what's going on in the calendar. We have the next Fed meeting, which is about a month and a half away on September 21st. We still have another jobs report, more inflation data, and we have Jackson Hole before we get to that Fed meeting. So you just want to watch and see when these events are happening and just be aware of it in your trading, because these type of catalysts tend to create traps. They tend to just chop up traders. So just make sure before you enter you have a plan for your trades. I do not attempt to even trade these data releases. To me, the only thing to do if you really wanted to do something would be maybe buy some calls like the night before and make sure they're far enough expiration that if the data doesn't move it, you just can sell the call at a net loss. Not a net loss, but just basically like kind of a break even. It's best to just watch and see these moves happen and then make your plan around them. The other thing I wanted to show you is that now we are at this 4,200 level. Man, these thunderstorms are creating amazing background sound. Hope you guys like it. So we're at this 4,200 level, which is psychologically very important because it's a whole number. We haven't been at this level for a very long time. And I just wanted to go over another way that I also look at the market is by looking at another time frame, the bigger time frames, obviously the 1 hour, the 195 minutes, the 390 minutes, the daily, just to kind of get an idea for my levels. So I created this Fibonacci retracement level back on August 3rd. And what Fibonacci is it's a way to kind of figure out where support and resistance are most likely to happen. And Fibonacci retracement levels are based off the Fibonacci sequence of numbers. So that's 23.6, 38.2, 50%, 61.8%, and 78.60%. So these percentage levels are areas where the price could stall, where it could reverse, or where it could move higher from there. So normally what you'll see is you'll see a move, and then you'll see it retraced to either 23.6 or 38.2. And then if it holds at this 38.2 level, odds are it will probably make a move back up to the 23 and then could continue on further, right? So I created this Fibonacci retracement level on August 3rd when we had this high here of 41.70, but we weren't able to hold it right then. So I took it from the low and I swung it up to that 41.70 level. So I started at 40.80.50, and the way I do it is if a level hasn't really been broken, like you see we came down here on August 2nd, but we didn't break it. So technically the lowest point was here, and then the highest point was here, and we didn't break this until the next day by a little bit, but I wasn't going to redraw it. I was just going to leave what I did. So I took these 2 days and I drew my level based off of these 2 days. And you could see here that the 61.8 level we hovered at for the past couple of days and yesterday and today prior to the CPI. Then we moved all the way back up on the 8th, really close to the 27% level, and this indicates what the continuation would be, right? So here we are above 4,200. As you can see, the 27% level is 41.94. The next level you want to look out for would be this 42.26. So that can kind of give you your supply and demand levels where price could then try to move to next, or it could reverse back down to this 41.70 level. And that's just another tool in your toolbox to kind of gauge how price is going to move. So you see here that we went all the way down to the 61.8 level yesterday, and then we even moved back up in it. Pretty much we stayed between the 38% and the 61.8% yesterday. And then today we had our massive spike up thanks to the CPI release. So I just wanted to share with you the Fibonacci retracement strategy. It's just simply based off the commonly used ratios. The most important are 23.6, 38.2, 50%, 61.8, and then the 78.6. Don't rely on them exclusively and just assume that the price is going to go back once it hits a certain Fibonacci level. Again, these are just tools to help you figure out your levels and high and low points that are relevant in what you're trading. So today is a day to sit on your hands unless you want to play in this kind of, I don't even know what this is. This is consolidation and chop. So unless you want to play in this, it's lower volume right now. I would advise, if you have a lovely day, go outside and play, or do something else. I am actually trading gold today in my sim. I did a really good gold trade, and I will make a video for you on that. One of the things that I'm working on learning is also trading crude oil and gold. So in my toolbox, I will be focused on ES, crude oil, and gold. So look out for that video coming probably by tomorrow. I just really want to like map it out and make it good for you guys. So that's all I have today. So, today's a day that it's sit on your hands and wait for better movement, wait for better volatility, and don't try to force things. That's one of the biggest things that I've learned, that I can't force a trade every day, or else you're just going to create unnecessary losers. And the biggest thing as a trader is preserving your trading capital so you can stay in it for the long haul. That's it. I hope this was helpful, and if you like it, please leave me a like. Please share this, and also please subscribe to my channel. Thank you. Have a great day.